A new study has revealed that some commercial banks in Ghana could face liquidity issues with the new cash reserve requirement placed on them by the Bank of Ghana. The research comes after the central bank decided to raise the amount of cash reserve it expects from banks. According to the study, this situation could limit credit to the private sector and ultimately result in the collapse, merger and acquisition of commercial banks as a measure to safeguard depositors. Thankfully, we've been joined by two researchers who came together with these findings. Dr. Rich Simon, the Tuahenem, is banking consultant and co-author. This would join his lead data and research analyst, Isaac Kofi Ajay. Let me start with you, Kofi. So, Kofi, run us through your findings.
So first of all, I will speak about what we looked at before we actually decided to embark on this study. And so we've been looking at three key data sets that inform this decision. So first one has to do with the non-performing loans that commercial banks currently have, which has moved from 15% to now 24.6%. And then also the activities of the central bank in the treasury bill market that has actually priced out a lot of private sector from this space. And then the fact that these same commercial banks that the Bank of Ghana is placing such high cash reserve requirements on them are the same banks that sacrifice during the DDEP program, where they sacrificed close to 50.6 billion Ghana cedis of bonds that they bought. Most of them were depositors' money. So we decided to check the liquidity positions of these banks to see how the current requirements from the Bank of Ghana is going to affect them in their liquidity position. So I'm sure Doc has a lot to talk about it, and we'll go into the findings of the research.
So let me bring it, Dr. Tuahenem, what exactly is this cash reserve ratio that commercial banks have to meet? And what is the danger here if they are unable to meet it?
Thank you very much. It's been a monetary tool which has been used ever since independence. Yes, it's a policy. It's one of the monetary tools used by central banks to control inflation and stem up depreciation of currency. Ghana has used it over the years, even during Nkrumah time. The 1988 financial sector reform, then where it was changed that we should come out from direct controls and come from indirect monetary policy control. All that it means is that banks are required to hold cash with the central bank for, say, 100 cedis. You keep 15%, no interest is paid on it. So if you lift it up, you increase it to 25%. So for every 100 cedis, the banks will have 25 cedis locked up with central bank, where interest is not even paid. Meanwhile, you would have paid interest before you got the deposit.
Right.
But because it's a practice, global practices, a lot of banks don't complain. And because of that, in other jurisdictions, like in Europe, you keep minimal, say 5%. But here, because inflation is always ahead of us, banks use it, the central bank use higher rates to control inflation. And again, at the same time, to stem the depreciation, to stop the depreciation of the currency. The recent one, what makes that recent one a bit quite interesting is that the banks has just come out from debt restructuring. And when we talk about the debt restructuring, the banks do not, as a bank, nobody has 150 billion deposit, which they used in buying the bonds. It was the customer deposit, which was used in buying the bonds. And the bonds were restructured. And the last payment will come in 2031. So if you add the restructured bond 50 billion to the total deposit of 224 billion, then it means that you are doing double counting. What we are saying is that governors should have taken the deposit that has already been restructured out of this and then do, say, with the 180 billion. But unfortunately, they just loaded them on the banks. And what it means is that the banks are going to have a little space to give credit. And the governor himself said that credit has declined by 29%. And at the same time, he was blaming the banks that why haven't they gone to give credit? Unfortunately, the other side of the equation is that the non-performing, which is the banks are experiencing recovery problem. And it has jumped from 15% to 24% within a space of 18 months.
And the people take loans and they don't pay back.
It's not them. It's not their fault. If you look at the last 18 months, the current economic challenges, higher inflation, persistent depreciation of currency, myriad of nuisance taxes, call it higher utility bills, higher fuel, higher labor costs, all these things dovetail into non-performing. But if you're looking at it, you may say that the banks are lazy. But the economic environment in which the banks find themselves now is not conducive.
Right.
And let me give you one example.
Right.
2006, 2007, I think 2007, 2006, 2008. Do you know that the banks had to go and plead with people to come and take car loans? Consumer loan was as cheap as 10%. Consumer loan was as cheap as 10%.
I remember the banks were taking people to take loans.
Yes, but what we have now, even the loans that you have, you're not able to recover because of the exogenous factors which I have already mentioned. So the banks decided that if we're not going to give loans and we're taking deposit, which will pay interest, why don't we go and buy treasury bill? And for goodness sake, it is you, the same government, who has created the enabling environment for lucrative treasury bills. So the bank decided to do what in banking we call lazy banking approach. Basically, go and buy treasury bill and have no problem with recovery. And then when you sat down there, you said, look, the people are buying too many treasury bills. Having forgotten that it is the government and you, the finance ministry, who have created the enabling environment. Now, having blocked their debt, having refused to pay their bonds, now you're telling them that you are also going to put a higher in non-interest bearing reserves. They are suffering from interest losses because no customer will give you a deposit without an interest. And again, you have destroyed the bonds over. I mean, it has never happened anywhere. I mean, it has had domestic bonds, not, I don't know which country. Maybe I think Jamaica and Ukraine and Russia some time ago did to the domestic bank. We have done something which is quite extraordinary.
All right.
And even that, sorry to say, and even that, the debt is rather increasing. The recent public figures came, we have jumped from 548 to 610 billion. So even the debt restructuring has not actually reduced the debt as such.
All right.
So you want to destroy the banks. That's what that we are saying.
Dr. Hussein, I'm sure we'll have more time to discuss this matter because of time. Kofi, final words on this matter, and then we'll have time to go into the nitty-gritty.
I mean, looking at the current problem that we have, if we say that we are using the current monetary policy tools to fight inflation, it's just like antibiotics. When you keep taking them, your body builds a certain immunity or resistance to it. That's the same thing happening in our economy, where we've kept using these monetary policy tools to fight problems that are basically fiscal. So we are recommending that the banks or the central banks should go ahead and do additional, 30% cut in their expenditure. They should look closely at the fiscal policy and leave the banks to have a breathing space, because they just went through a debt restructure. They've not fully recovered yet, and they cannot take this huge cash requirements that Bank of Ghana is trying to place on the melting.
All right, I'm sure there'll be more on this on Joy Business and, of course, on Newsnight and Joy News Prime.